Welcome back to the Deep Dive. Today, we are digging into CMC's fiscal Q1 2026 earnings call.
And this one is a really fascinating case study. It presents this huge tension right from the start.
What's the tension?
Well, you have management delivering what was, by any measure, an excellent quarter. They just beat expectations handily.
And yet the stock got hammered. We saw a pretty dramatic drop. It's that classic sell the news event, right?
Exactly. It suggests either Wall Street had priced in absolute perfection or the forward guidance had some kind of poison pill that just overshadowed all the good news.
So that's the disconnect we need to untangle here. How does a company that's firing on all cylinders, with surging margins and a huge new acquisition, still manage to disappoint the street?
That's it. The goal is to figure out how the market's focus shifted so quickly from the phenomenal quarter they just reported to the perceived weakness in the quarter that's coming up.
Okay, so let's start there. Let's unpack the headline beat first, because we have to establish just how strong this Q1 really was. This wasn't a minor win.
Oh, not at all. If you just look at the raw financials, they crushed it. Absolutely crushed it. Adjusted EPS, earnings per share, came in at $1.84.
$1.84, and the consensus was what, somewhere in the 150s?
Yeah, $1.56. So that's a huge beat. It sails right past the consensus.
And revenue followed that same pattern.
It did. They hit $2.12 billion, where the street was looking for about $2.05 billion.
Yeah.
So, that's a really solid 11% year-over-year growth.
But the number that really jumps out, the one that points to some serious operational strength, is the profitability metric.
Right. The consolidated core EBITDA, that hit $316.9 million.
And just think about that number for a second.
It's up 52% from the year before.
52%.
When you see operating profit grow that fast, something fundamental is changing for the better in the business.
Okay, so that immediately begs the question, why the drop? Why did shares fall, 3.5%, almost 4% right after the call?
The trading data tells the story. Volume just spiked. It hit nearly 241% of the average.
So a lot of shares changing hands very quickly.
A ton. It just shows a high velocity of selling and a really rapid change in focus. The market wasn't just, digesting the good Q1 numbers. It was making a very swift collective bet that whatever was coming next was more important.
And expectations were already pretty high going in, weren't they? The options market was pricing in a big move.
Yeah, the market implied move was around 7%, so the stock was coiled for some kind of big reaction. It sounds like they needed to deliver not just a phenomenal quarter, but a phenomenal quarter plus perfect guidance to avoid this.
And they didn't get the second part.
They didn't. They delivered on the past, but the market was scanning that forward-looking statement for any sign of weakness. And we'll get to what they found, but first, let's give credit where it's due. Let's zero in on the story behind that 52% EBITDA surge.
This is where it gets really interesting. The North America Steel Group was just an absolute monster this quarter. What was the secret sauce there?
That group was just outstanding. Adjusted EBITDA of almost $294 million. That's up nearly 58% year over year.
And that translated into a margin of 17.7%?
A very, very strong 17.7% margin. And this wasn't just luck from higher steel prices. Management was really clear about this. It was strategic operational discipline.
They mentioned a specific tailwind, right? A metal margin tailwind of $53 a ton.
They did. They managed to push through a $57 price increase while keeping their main input cost, scrap, basically stable. That just screams pricing power and cost control at the same time.
And that's where their internal programs come in.
Exactly. They have this efficiency initiative called TAG. And a big focus right now is on scrap optimization. So this isn't some complex macro story. It's them getting better at their own process.
So they're just using less scrap for every ton of steel they make.
Pretty much. They're rolling these initiatives out across all their domestic mills.
Yeah.
And it's structurally lowering their costs. That's a durable advantage.
Which is way better than just riding the price cycle. But they also talked about something else, a shift in commercial rigor, I think was the phrase, especially in their downstream fabrication business.
Yeah, and this is a really important change in philosophy. They're intentionally increasing that discipline. What it means is they're being super selective. They're willing to walk away from work if it doesn't hit a certain profit threshold.
That takes guts in a cyclical industry, prioritizing margin quality over just, raw volume.
It does. And the data is already proving them right, which is key. Even though they're being pickier, their downstream backlog volume actually went up a little bit.
And I'm guessing the price of that backlog is more important.
That's the critical piece. The average price in that backlog is improving, so it confirms the strategy is working. They're shedding the cheap stuff and replacing it with better quality, higher priced projects.
Okay, so if we zoom out a bit to the macro picture, what's supporting this?
Well, U.S. demand is still really stable.
Yeah.
You have these key pillars holding everything up.
Yeah.
Public works, data centers, which are just exploding.
Right.
Institutional buildings and big energy projects. They even called out success in specialized LNG projects.
And the leading indicators look good too.
Flashing green for the long term. They pointed to the Dodge Momentum Index, the DMI, which predicts non-residential construction about 12 to 18 months out. That index was up 50% year over year in November.
50%. Okay, wait a minute. If the DMI is up 50% and their execution is fantastic, that just makes the stock drop even more of a mystery.
I know, it deepens the puzzle, right? Why would the market freak out over a little short-term noise when the long-term pipeline looks that good?
Which brings us to the next big strategic shift, the one with huge long-term implications for how you even value this company.
Let's talk about the new segment, the Construction Solutions Group, or CSG.
This used to be called EBG, right? Why the name change?
It's way more than just a cosmetic change. It reflects a fundamental shift in the business. Over 95% of that segment's EBITDA now comes from these high-margin construction market solutions.
So they're moving up the value chain.
Big time. They are transforming that part of the business into a specialty construction play. And it's already paying off. CSG had a record first quarter. EBITDA of almost $40 million, which is up nearly 75% year over year, with a fat 20% margin.
They also mentioned Tensor, the business they acquired a while back.
Right. It had its best Q1 ever under CMC ownership. It just shows that the integration and the new focus are working.
And the centerpiece of this whole pivot is the massive precast concrete acquisition that just closed.
Yes, this is transformational. They bought CPMP and Foley products, and basically overnight, they created one of the biggest precast concrete businesses in the U.S. They're not just selling rebar into a construction site anymore. They're selling a finished, higher value product.
That sounds a lot less cyclical, a lot stickier. What kind of financial impact are they guiding for this?
It's massive. The guidance is for these new businesses to add between $165 and $175 million in EBITDA in just the first 8.5 months of ownership.
Wow. That's almost half of what the entire company just generated in Q1.
Exactly. And they're targeting incredibly high margins for this business, somewhere between 30 and 35% EBITDA margin.
Okay, numbers like that are transformational, but big acquisitions cost money. The market always worries about the debt. How's the balance sheet looking?
It's manageable. Pro forma net leverage is about 2.5 times adjusted EBITDA. And that's actually a little better than they previously guided, thanks to the strong Q1. But, and this is a big but, management made it crystal clear they are laser focused on deleveraging. The number one priority is getting that leverage below 2.0x within 18 months.
And that priority has a direct consequence for shareholders, right? Specifically for buybacks.
It does. They confirmed they are slamming the brakes on share repurchases while they pay down this debt. They're only buying back enough to offset what they issue for employee compensation.
So the message is clear. Capital is going to debt reduction and integration, not to buybacks in the near term.
It's a trade-off. Growth and stability now versus an immediate shareholder return. They do have plenty of liquidity. They bumped up their credit line to $1 billion. So this is purely about discipline.
All right, we have to do it. Let's transition to the elephant in the room, the guidance. This is what caused all the pain. If Q1 was a home run, what on earth did they say about Q2 that spooked the market so much?
It was a few things, but the headline is that they expect consolidated core EBITDA to decline modestly, sequentially, and they blamed a normal level of slowdown.
Normal slowdown. That's analyst code for seasonality, isn't it?
100%. Specifically for that big North America steel group, EBITDA is expected to be lower for two reasons. One, seasonal volumes, winter weather, and two, planned maintenance outages.
So construction slows down in the winter and they take some mills offline for tune-ups.
Exactly. They guided Q2 volume to drop somewhere between 5 and 10% from Q1. And even though they said the metal margin should stay pretty stable, that volume drop plus the maintenance hit is enough to wipe out Q1's outperformance.
So the analysts on the call were basically doing the math and saying, okay, the $50 million of upside we saw in Q1 is going to be completely offset by $50 million of downside in Q2.
That's the back of the envelope math. Yep. And then you throw in the final kicker, Europe.
The outlook for the Europe Steel Group was really weak, wasn't it?
It was. They're guiding that segment to be approximately break even in Q2.
Oh, break even.
Yeah. They're blaming import pressure and some weird timing stuff with CO2 credit rebates. Europe's just a tough market right now.
But management is trying to frame that as a temporary problem, right? They're pointing to this massive regulatory catalyst that they think is going to provide a huge structural tailwind later in the year.
They are.
Yeah.
And this is where we have to understand the acronym CBM.
Carbon Border Adjustment Mechanism.
Right. It took full effect on January 1st, 2026. And it's basically a tariff on high carbon imports coming into Europe. This is huge for CMC because their Polish operations are relatively clean and modern compared to a lot of the imported steel they compete with.
So if the dirtier imported steel now has to pay a carbon tax, it levels the playing field for their Polish mills.
It does more than level it. Management thinks CBAM will add at least $50 per ton to the cost of some of those imported products. That's a structural advantage for them, and it's on top of the CO2 credits they already get for being cleaner. It's a non-cyclical self-help story the market seems to be totally ignoring.
Plus, you have the EU safeguard quotas tightening up mid-year, just another layer of protection.
Correct. So the story is weak Q2, but a strong structural recovery in the back half of the year driven by trade policy. And real quick on capacity, they said they're not worried about new supply in North America. Imports are down, and demand drivers like reshoring and AI are strong.
And the big West Virginia mill project.
On budget. Hot commissioning starts in June 2026, so that future growth is still firmly on track.
Okay. We've covered the amazing Q1, the transformational deal, the strategic pivot, and the predictable seasonal sell-off. Now it's time for our segment, which of course comes with the required disclaimer.
This is not financial advice. We're just putting the pieces together, synthesizing the market reaction and the company's strategy to find an outrageous but plausible trade idea.
And the thesis here seems pretty simple. The market is punishing the stock today for something totally predictable, winter weather and maintenance, while completely ignoring the huge structural catalysts that management actually controls.
That's it. You've got about $50 million of Q1 operational strength being perfectly offset by about $50 million of Q2 seasonal weakness. It's a wash.
And that wash is giving you a huge discount on the really important long-term changes.
So the outrageously plausible trade idea is this. You initiate a long position right now. Not as a bet on where steel prices are going next quarter, but as a leveraged bet on European trade enforcement and the precast integration cadence.
So you're betting on the execution team and on government policy, not on the commodity cycle. Why Europe?
Because that $50 per ton CBAM impact, plus the $30 per ton in CO2 credits they already have, means that Polish business is set up for a structural, non-cyclical move from break-even toward historically high profits.
And the second part of that bet, the precast integration.
Right now, the market is treating the $165 to $175 million in new high-margin EBITDA as if it's a huge risk. They're discounting its value. So you're basically buying a cheap call option on management's ability to execute and deliver those numbers. If they nail the integration and those European trade winds pick up, this Q2 dip becomes a tiny footnote.
So it's a bet on the durable improvements from the TAG program, which is aiming for $150 million a year, and the delivery of those 30-35% margins on precast instead of worrying about snow in February.
It's focusing on what's fundamentally changing the business model toward value-added protected margin products.
Okay, so to recap the whole deep dive for you, the listener, CMC delivered a phenomenal Q1. They showed real commercial rigor and operational execution with their TAG program, which juiced their NA steel margins. And they secured their future by closing that huge precast deal.
And all that strength was overshadowed. The stock weakness was driven entirely by that seasonally weak Q2 guidance, the typical volume declines, the maintenance, and that near-term break-even outlook for Europe. The market punished predictable, short-term noise.
Which leaves us with this final thought for you to mull over. Given the company's high confidence in getting to $150 million in TAG benefits and in delivering $165 million or more in new EBITDA from the precast platform, is this Q2 seasonal weakness the exact buying opportunity for anyone betting on long-term structural execution over short-term cyclical noise?
That's the analysis you have to factor into your thinking.
We'll catch you next time on The Deep Dive.